Good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, Certified Financial Planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your own personal financial situation or anything I'm talking about here tonight, jump on the phone lines. Give me a call, 627-7979. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air, 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interests ahead of our own in any business dealing or recommendation that we make, and that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals. But that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday at 6 p.m. And that's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success. Because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security. They choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. You have to want it. We are here to help. You got to take that first step, though. Pick up the phone, give me a call, 627-7979. Whether you want to talk about anything having to do with the investment markets, with the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, retirement planning, retirement plans, 401ks, 403bs, TSPs, IRAs, Roth IRAs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella of personal finance. We are here to discuss tonight, 627-7979. All right, tonight I come from the future, and we are going to talk about the financial advice people wish they had followed 10 years earlier. So one of the things that we have the pleasure of doing in our practice is meeting and working with people who are typically in their 60s, 70s, 80s, and even 90s. And until recently, we even had a client who was 103 years old. She had lived a very long and healthy life right up to the very end. But we get to work with people in that demographic, and what a lot of those people have is wisdom of a lifetime of learning, and we get to sit in on conversations and help direct the conversations sometimes so that they are telling us and passing along to us certain tidbits of wisdom of things they've learned through the years. And what we do with that information is then take that back to the rest of our client base and the younger aspects of our client base and impart that wisdom that we take from people who are in their 70s, 80s, and 90s. So we're going to do some of that here tonight. Some things that I've learned along the way, as well as things that we know from a financial standpoint that people wish they had done earlier. So most of life's most powerful lessons come from hindsight, right? Experience is the best teacher. And when individuals reach their 50s, 60s, and 70s, they often look back and realize that a handful of financial decisions made earlier in life would have made a really significant difference in their financial confidence later on. So tonight we're going to talk about some of the financial advice people commonly say they wish they had followed earlier. I'm not here to criticize any past decisions or make fun of people or talk down on people who maybe aren't doing some of these things right now. I am coming from the future to give you some wisdom that we have learned along the way, and then hopefully motivate you to take action on it today instead of waiting. So most people did the best they could with information that they had at the time, but the goal tonight is to help you identify the decisions that matter most so you can make better choices going forward. So we got some real-life patterns, some research, financial planning experience, and we'll help you understand how small decisions made over time can compound into meaningful long-term outcomes. So the first thing I want to talk about is the power of hindsight. And one of the most common things that we hear from clients is some version of, I wish I had started earlier. I wish I had done this earlier. I wish I had come to you sooner. Financial hindsight tends to reveal patterns, and certain decisions repeatedly show up in conversations about regret about why I didn't do something earlier. So this is borne out not just in our practice, but in studies across the industry. Northwestern Mutual had a study in 2024 that said nearly half of Americans say they wish they had started saving for retirement earlier. And then the Federal Reserve Survey of Consumer Finances in 2023, household net worth varies significantly depending on long-term saving and investment habits, right? So the earlier you start, the easier it will be long-term to accumulate wealth. So financial decisions, just like sort of interest, compound over time. And the little decisions you make when you're younger have the butterfly effect of having large outcomes, positive and negative, later on in your life. And when it comes to finances, it's the early habits that matter more than perfect timing. So, waiting until you have all your student loan debt paid off to start contributing to your company retirement plan, that's, that could be 10 years in the workforce before those student loans are paid off, before you have the wherewithal to start contributing to your company retirement plan. That's 10 years of missed growth on the savings that you put into that company retirement plan. So delaying these saving opportunities to accomplish other, or saving for a down payment of the house, that's another big one, right? When people get in the workforce, want to buy that first house. Well, committing all that to your student loan and saving for the house, well, usually the retirement funds don't really get much attention. And plus, hey, when you're in your 20s, what's retirement anyway? That's a lifetime away. I don't have to worry about that now. Well, I'm here to tell you that the actions you take in your 20s can have a real meaningful impact when you're in your 60s and your 70s. And, unfortunately, many people only recognize these important lessons later. They get into their 40s and their 50s, and maybe they have delayed meaningfully saving for retirement or trying to build net worth over time. Time is a non-renewable resource for all of us. It goes in one direction. We don't have the ability to go back in time and change the decisions we made in the past. All we can do is deal in the present and make the best decision today for the future going forward. And so the idea of hindsight can be used as a learning tool instead of a form of regret. And so that's what I hope to sort of impart today, is the hope that no matter where you are in life, what age you are, what income bracket you're in, how much you have saved or have not saved at this point, where you are today is the first day of the rest of your life and the rest of your financial future, and we're going to help you try to make the best of it. Going to take a short break right here, and we'll be right back after these messages. 627-7979. If you want to jump in on the conversation, I'm Certified Financial Planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Pathway Financial
welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. All right, tonight we're talking about the financial advice people wish they had followed 10 or more years earlier. So financial planning is a lot like kind of planting a tree, right? The best time to plant it in order to enjoy that tree, probably about 20 years ago, right? But the second best time to plant that tree is today, okay? So today is the day where we start taking stock of where you are in your financial life, where you are from a career standpoint, where you are from a family standpoint, and hopefully take some actionable steps over the next few days or weeks in order to get yourself in a better financial situation going forward. So as I said at the beginning of the show, probably the one of the biggest financial lessons learned from hindsight is that people say they wish they started saving earlier, right? The most common financial regret people express, not saving earlier. And time is the most powerful factor in long-term saving and investing because it allows compound growth to work. The more time you have, the less you need to save over those increments of time in order to one day amass a nice sum of money. The longer you wait, the longer you delay to start savings, the more you're going to have to commit to that saving or investing plan in order to sort of catch up to where you want to be or where you should be. A couple other studies that support this: Federal Reserve Survey of Consumer Confidence a couple years ago. Retirement accounts represent one of the largest sources of financial wealth for middle-income households. And then Vanguard had a retirement research paper in 24. Consistent contributions over long periods are a primary driver of retirement readiness. Yes, this is what we say when through the radio show and when we talk to our clients and their adult children. Some of them, when we meet with our clients in their 50s, they might have children in their 20s, early 30s. And when you're in that period of time, you have a lot of competing interests for very limited funds because you're new entrant to the workforce, entry-level jobs, probably the lowest amount of income that you're going to make throughout your career. Hopefully you steadily grow that career, get raises, promotions over time. So there's a lot of competition for very finite resources when it comes to your household income. So instead of sort of bucketing our finances and thinking about one thing or the other, like I said at the beginning of the show, like instead of just targeting the student loans and just trying to save for the new house or just trying to buy the new car and pay that off as quickly, really we favor the shotgun approach, and that is trying to do a little of as many of those as you can, because the most important long-term planning tool that I believe we all have are the habits that we start at a young age. And it's those habits that will allow us to stay the course throughout our lifetime to steadily grow wealth over time. Most people today, most Americans, we're not used to waiting. We're not used to having patience. We want everything we can get now. And you can do that in a lot of cases with credit and with loans and credit cards and mortgages. There's almost always a lender out there to loan you money, a lot of times at a very high interest rate. But there's almost always someone out there that will let you buy something on credit so you can have it today and pay for it tomorrow. So you have to kind of resist these psychological economic forces that are that swirl around us with commercials and billboards and in movies, where everyone seems to have a real fabulous, wealthy life. And you're like, I want that too. Well, we believe you should have that too, but we also believe that you should do it financially responsible. So it's important to try to start the habit of saving as early as you can. As soon as you get that first job, the next thing you should do is sign up for your company retirement plan and try to contribute as much as you can to that company retirement plan, at least the amount to get the full company match, because that's additional free money your company is giving you to incent you to give to contribute to your own retirement and the company retirement plan. And if you delay doing that until you have enough money to do that, then the weeks turn into months, which turn into years, which turn into decades. And then we've sat with the people who are in their mid to late 40s or early 50s, and the retirement idea in that age bracket is no longer theoretical. When you're in your 20s and 30s, retirement is a theoretical concept. But once you hit late 40s and early 50s, all of a sudden theory turns into practice. And people will start to realize, oh yeah, I guess this thing called retirement is a real thing. It sounds pretty cool. I want a part of it. I want to be good, but I need to have a fair amount of money, because if I want to retire, my income's going to stop and I have to replace it somehow. So starting the habit of savings is probably one of the most valuable things that you can do, or you can impart on your kids to get them in the habit of just saving. So when they get that first job, sign up for the company retirement plan. I don't care if it starts with $25 a paycheck. It's the habit. And then 6 months from now, increase the $25 to $50 a paycheck. And then in 12 months, the $50 to $100. Okay? Just start. So many people don't even take the opportunity to start saving in their company retirement plan. And every year that goes by is a year that is missed in saving and investing and in compounding. And to put, some numbers on it, if you were trying to get to say $1 million over your lifetime of savings at an 8% average annual rate of return, if you contributed a monthly amount for 30 years, it'd be $671 a month. You could put away $671 a month every month for 30 years and get 8% on that money. You'd be a millionaire. 30 years. If you wait 10 years and you try to accomplish that same $1 million in 20 years, now it's going to cost you $1,700 a month. So about 2.5 times more you would have to put away over a 20-year period instead of 30. And if you wait and try to do it in 10 years, then it's going to cost you $5,430 a month to get to $1 million in 10 years at 8% rate of return. So you can see by delaying, it's going to cost you more in savings to get to the same point. So the earlier you can start, the less it would cost on a monthly basis to get to the same goal, because that's how compounding works over decades. So consistent contributions matter more than market timing or the exact right type of investment. I should say this does assume a well-managed, growth-oriented, properly diversified investment portfolio, which an 8% long-run rate of return should be achievable long-term with that type of investment management. And an employer retirement plan are set up to help you do just that. It makes it very easy. It comes right out of your paycheck before it even hits the bank account. It has a pre-selected menu of investments in the plan to sort of focus your choices and narrow down the universe to make it more manageable, and they incent you by providing a company match. So you've got to take advantage of the plan in order to get the match. So the longer you wait, the more it's going to cost you, and compound growth is kind of like a snowball rolling downhill. The longer it rolls, the bigger it gets. The more time that you have to compound your savings, the bigger the savings becomes, the more you grow your net worth over time. And the longer you delay in waiting to start that savings plan, the harder it's going to be, or the more money you're going to have to commit to that. And then secondly, after you commit to your savings plan, then you need to make sure you get it invested in the right vehicles in your savings plan, in your retirement company's retirement plan, or directly through a brokerage account or in mutual funds. And then you're going to have to stay invested through market ups and downs. We'll talk more about that when we come back after the news. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes there, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you the information that you request. And for those of you who have some nuanced questions, want to speak to a live human being, give us a call at the office, 456-2200. Want to remind everybody, our next live show will be in 2 weeks on Tuesday, March 24th. But if you can't catch us live every second and fourth Tuesday of the month at 6 p.m., get the show as a podcast. Search for Dollars and Common Sense wherever you get your podcast. Download us, take us with you wherever you go, and listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors. Hit that like or follow button. And once every week or two, we put up an interesting and informative financial planning post to keep you engaged in the process. Okay, tonight we're talking about financial advice people wish they had followed 10 years ago. Talked about the power of hindsight, talked about how one of the biggest regrets is people saying they wish they started saving earlier. And then here's another one. People stay invested through market ups and downs. People wish they had stayed invested through market ups and downs. A lot of times, we will hear from new clients that one of the reasons that they came to work with us is some investing mistakes that they've made in the past. And typically the biggest investing mistake they make is when they sell out through a market downturn or through a bear market, is when the financial pain becomes too great to continue to watch the declining values of their retirement accounts or their IRAs or their brokerage accounts, and they just kind of want to make the pain stop, so they sell out all their investments, and then they convince themselves they'll get back in when things stabilize or when things look better. Unfortunately, for most people, what that means is after the market then recovers. And so what you've done is you've locked in losses by selling low, relatively low, And then you've missed the eventual inevitable market recovery because you weren't invested it over that period of time. And so then you buy back in when prices of stocks and mutual funds and ETFs have gone up. So you've sold low and you've bought high, and you've lost a big chunk of market return. So you've got to stay invested through those occasional, inevitable but temporary market downturns, and you're not going to time your way around them. No one can do that on planet Earth. If anyone could reliably, they would have figured out how to do it by now, and they would amass basically trillions of dollars. So that has not happened. It can't happen. In the short term, the market is almost perfectly random in its ups and downs. It's only when you look at the investments markets from a wider lens that you see it's basically an upward trending vehicle. At least most investments, most good investments, are upwardly trending, but they don't go in a straight line. So you have to be willing, if you want good, solid, long-run rates of return of 7, 8, 9% on average per year, then you have to endure the occasional setbacks. So people tend to regret reacting emotionally to market volatility. They don't have a plan. They don't have a strategy. They just know the investments are going down and they want it to stop, or their spouse wants it to stop, and so they react emotionally instead of logically. And investors who move in and out of markets frequently miss periods of recovery. And financial media does you no favors, because financial media is designed to sort of stir the pot, to agitate, to always make you second guess what you're doing. I have a shorthand saying that CNBC is hazardous to your wealth. It's like investing entertainment. It's not a place for real, solid, long-term investment or financial knowledge. It's like dopamine for investing. They talk about things in terms of time periods of minutes. What's the market doing now? What's it doing this hour? What's it doing at the lunch break? Who cares? It doesn't matter. But they make you think it matters, so you feel like it matters, and it feels like it makes you think that you need to do something in a very short-term focus. That's not good investment management. Good investment management, by its very nature, is methodical, systematic, process-oriented, and long-term in its very nature. So a couple studies bear this out. Dalbar quantitative analysis of investor behavior in 23 shows that investor returns often trail market returns due to poor timing decisions. And long-term market history demonstrates that markets experience volatility, but have historically trended upward over extended periods. And so this is the difference between emotional investing and disciplined investing. If you don't have an investment plan, a strategy, at Wealthway, we create an investment policy statement for all our clients when they become a client, before we invest $1, and we lay out our investment program to our new client and say, this is how we are going to invest your money. This is what you can expect reasonably from the performance of that money. And here's what we will do. Here's how we will manage it. And here's how we won't manage it. And one of the ways we will not manage our clients' money is with a short-term or market timing focus, because that is proven time and time again to, if not just outright destroy returns, at least cause them to be suboptimal. So having that plan and strategy in place is what prevents you from making the emotional decision. You have to recognize that market volatility is normal, is natural. It's the price, we like to say, of a elevated long-term investment performance return that far outpaces inflation, outpaces bank products like mutual funds and money market funds and CDs. That's what we have to endure in order to get 8, 9, and 10% average long-run rates of return. And the cost of missing the best days is catastrophic to that long-term return. And very frequently, the best periods of time, the best days, come very quickly after the absolute worst days in the market. There's a very sort of mirror-ish quality between the down periods of the market and then the subsequent up markets. The sharper and steeper the decline, typically the sharper and quicker the recovery. So just when you feel like you can't take it anymore and you're about to throw in the towel, that's probably about the time when market's about to turn. So trying to time the market is like jumping on and off a moving train. You risk missing the ride entirely. And so that's staying invested through market ups and downs. That's one of the people's biggest regrets. Another one that they have that I'll talk about after our last break here is avoiding lifestyle creep, and that is entirely within your control. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. All right, tonight we're talking about regrets. I've had a few, and advice people wish they had followed 10 years earlier or more. Talked about staying invested through market ups and downs. Here's another one that people often lament after the fact: avoiding, or I should say, lifestyle creep. And they wish they had avoided lifestyle creep. So as incomes grow, spending often grows just as quickly, right? The more you make, the more you feel entitled to spend. I mean, that's what you're working for, right? The more we earn, the nicer, the bigger the house I can get, nicer neighborhood, better location, nicer car, fancier furniture I can have in the house, nicer clothes I can wear, more lavish vacations I can take, right? The more we make, the more we feel entitled to spend. And that's what's known as lifestyle creep. But then many people later realize that they could have saved more if spending increases had been moderated. So I'm not telling you to not spend, as your income increases, not spend more, but maybe don't spend as much as those income increases, right? If you get a $1,000 a month raise, then don't go out and start spending $1,000 on stuff. Spend $500 on stuff and take that other $500 and pay off bad debt. Build up your emergency fund. Commit it to your company retirement plan, or start saving outside of the company retirement plan so you have more liquidity, right? The more you make, the more you should also be saving as well if you want to have financial security at some point of your life, and ideally maybe even financial independence when you don't have to rely on anyone else or any employer for income if you've saved enough. Many times, if we have a long enough runway with our clients, we get them to the point of financial independence where they no longer have to work for money. They work because they choose to, and they work in a line of work that brings them happiness and fulfillment instead of a dead-end job or with a boss or employees that they can't stand. They're working for choice and achievement purposes and validation, not just for a paycheck. So some supporting data for this, Bureau of Labor Statistics shows that household spending tends to rise as income increases. Again, rising is okay, just not as fast as those income increases. And then financial planning research frequently highlights the importance of maintaining a savings rate as income grows. So there's a good sort of metric you can put in your back pocket. You don't have to worry about a dollar amount per se if you go with a percentage. You try to save a certain percentage of your gross income from the moment you enter the workforce for the rest of your life. So make the numbers easier, 10%, right? So 10% of your $50,000 starting income is $5,000. That's what you should try to save through a combination of sources, whether that's into a money market, whether that's into your emergency fund, whether it's into your company retirement plan, whether it's in a brokerage account, whether it's with a mutual fund or ETF fund directly like Vanguard or Fidelity. 10%. And no matter how much you make over the rest of your life, you always save 10% of your gross income. You are at some point, and you invest it properly in a growth-oriented portfolio, properly diversified, you will eventually get to the point where you will amass enough investments and savings that you can live off of that money and replace your existing lifestyle without having to earn a paycheck to do that. Okay? But you can't allow your lifestyle to creep beyond what you are earning. If you never capture that additional income, you're never going to get there. If you're always spending everything you make, you're not going to have anything by the time you hit 60. And you're going to have Social Security, and that'll be it. And so what happens from a practical standpoint is most people, they just keep working. Right, because they don't really have a choice. Social Security only replaces for most of us a third at best of our pre-retirement income. So Social Security does not get it done on its own for most people. Social Security plus savings and investments, and for a few of us might still have a pension possibilities, work for the government, federal government, state governments, municipalities, city governments, teachers. Some hospitals still have pension programs. Dominion Power, some big utilities still have pension programs. But for most of us, pensions have gone away. So it's going to come down to Social Security and what you've saved up. And so don't allow your lifestyle to get ahead of your income. Modest adjustments can significantly improve long-term outcomes, and financial habits matter more than income alone. So, like I said, 10%, okay? That's all you have to know. 10% of your gross income goes into long-term savings that won't be touched except for retirement-type purposes, okay? And if you do that over the entirety of your career, from the time you're 20 to the time you're 60, you will have enough money saved up that you can support your existing lifestyle at that point in time for the rest of your life, with a high probability of never running out of money and never having to work another day in your life, and never having to rely on somebody for your income for the rest of your life. So lifestyle creep is like filling a bigger suitcase every time you travel. No matter how large it is, it eventually gets filled up. It's human nature. The more we earn, the more we make, the more we want to spend. You've got to resist that temptation. It's your habits. It's your behavior that matter more than whatever mutual fund you're investing in, whatever stock you purchased yesterday. All that stuff is secondary to the habits that you build up. And then another Another regret that we often hear people lament is to seek guidance and plan earlier. So many people say that they wish they had sought financial guidance earlier. Planning conversations often help people avoid costly mistakes and stay focused on long-term goals. So getting a professional involved. If this is not your strong suit, and most people it is not, despite what they think, most do-it-yourselfers wildly underperform the work that they do with a competent, trustworthy professional financial advisor. So most people are better off with a good financial advisor than going it alone. And that has been proven by CFP board research, which indicates that individuals working with financial professionals often report greater financial confidence. And studies on financial literacy consistently show that guidance improves decision-making and long-term outcomes. You work with a professional to get your car repaired because you're not an expert in car repair, even though you might. I don't even know what the spark plugs are anymore in the car. I am not a car expert, so I take it to a professional who is, and I pay him a fair price in exchange for good work. Well, the same goes for a dentist or a doctor or a financial advisor. A good professional can make your life much better, fuller, and richer. So the value of a coordinating financial plan with investment management is where you get the biggest bang for your buck. Investment management is of limited value by itself. All we get out of investment management is just a rate of return. But the rate of return doesn't tell us, are we saving enough? Did we save enough? How much is enough? How much can we spend without fear of running out of money over our lifetime? All of those questions are answered through financial planning. Financial planning done well analytically with investment management is when you get your answers to life's big financial questions and you know whether you're on track, you know whether you're saving enough at this point of time. You can rest easy. You have the peace of mind knowing that you will be able to retire at age 55 or 60 or 65 or whatever age you're shooting for. All right, that's about all the time we have for tonight. One final last closing thought. Financial success is rarely the result of one perfect decision. It is the result of hundreds of small decisions made consistently over time. Until then, we'll be back in 2 weeks on Tuesday, March 24th. I'm certified financial planner Kevin Zivna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS.